Hello out there. Welcome to Macro Mondays at Real Vision. My name is Mikkel Rosenvold, and I'm very excited to host this show once again. With me as usual, Andreas Steno. Welcome to the show, Andreas.
Thanks, Mikkel. It's been quite the weekend here in the north of Europe.
You have to admit so.
Yeah, but let's have a discussion around what's next.
These are very, very special times. Let's just get the elephant in the room addressed. It's very, very special times to be Danes on an American platform here. But we're doing fine. We're going to Miami on Wednesday. We're very much looking forward to that. And still having a lot of fun, doing some great stuff here at Real Vision. So let's try and keep things separated. But obviously, we do have to talk Greenland, Andreas. It's affecting everything, and we'll get all around that. But also try and talk a little bit about the broader macro picture at play, Andreas. Before we get to that, remember, guys, that this is our free show at Real Vision, our free weekly macro insight show, to give you a sneak peek into our thinking and our analysis. To get the full picture, to get our flagship reports and our access to our model portfolio, you have to sign up for Real Vision Pro at realvision.com. Lots of good stuff in there, including our weekly catch up with Roll Pal on Friday. Great show. You can catch that as well with the Pro here at Real Vision. So really recommend that. Even though, Andreas, we've had a great start with with our model portfolio so far, we'll get back to that a little bit later. We have to issue our regular reminder here that we try to be very actionable, we try to be very concrete in our recommendations, but they may be
sometimes maybe good, sometimes maybe shit.
Exactly, that's the way it is, and always has been, Andreas. So we don't have any trading in US markets today, Andreas, but we all obviously have futures, and we have European markets opening up in crypto, etc. Looks like it's going to be quite a heavy start to the week, mainly due to Greenland, or how do you view that, Andreas?
Yeah, I guess it at least is a partial explanation behind what we've seen. We have metals flying, we have Bitcoin slightly down, we have equity futures down, etc. Right? But over the course of the very early trading between Sunday and Monday, our time here in Europe, we obviously also had a message out of Japan on the upcoming election, right? And the Japanese yield curve responded. If you look at the 30-year yields, I think they're up like 12 basis points, something like that. So it's a pretty nasty move, and that's probably also at least partially behind what we see in everything from equities to metals, etc. So in that sense, it's actually a little bit hard now that we don't really get to see what the U.S. crowd will do until tomorrow, right? And I'm kind of tempted to say that it's driven by both the Japanese election and this Greenland story. For now, I'm also tempted to say that we remain in a tit for tat bureaucratic semi-escalation. I don't really consider it overly worrying at this juncture. The tit for tat escalation between the US and the EU, but obviously there are some scenarios that could bring us in a worse direction. And my fingers are crossed that we're not going there, but I mean, I don't think it could be ruled out at this juncture.
Oh, not at all, Andreas. Let's do a little bit of a recap here, just to understand the Greenland and tariff situation. So last week, the Danish foreign minister went to Washington, had a meeting with Rubio and Vance. He tried something very Scandinavian, very European to establish a working group to address this issue. The two sides weren't quite in agreement on what this working group would do, but that's sort of the point. You put a bunch of people together, and I think what the EU and Denmark is trying to do here is to pull it down the hierarchy as much as possible, because dealing one-on-one with Trump is very, very tricky. Dealing one-on-one with Vance is almost as tricky. But once you get further down the chain, maybe even to career diplomats in the U.S. Secretary of State, it's easier for Europe. They're more used to dealing with these kind of people than the MAGA politicians, and I think that's what the Danish tried to do there. and try to set up sort of a bureaucratic process that you can discuss details and numbers and technicalities. Obviously, Trump has no patience for this, so he grabbed into his toolbox and grabbed out the tariff weapon. And I just wanted to say before we get into that, Andreas, the positive reading here is I would rather be hit with a tariff than with a cruise missile. That's the silver lining here. We're not talking about war anymore. I know it's not off the table, but we're not talking about invading Europe or whatever. We're talking about a trade war, which is much better than an actual war. Nonetheless, Andreas, a broad tariff on 10% on various European countries, which in essence means the European Union, to be raised to 25% along the way. How serious is this for global markets if it becomes a reality?
Yes. So let me start by saying that even if I agree with you that a tariff war is obviously better than an outright war, I don't really think anyone dared to even think about that, even though it's been rhetorically explicitly mentioned. Most people consider that negotiation leverage and so on and so forth. I do that as well. I consider the actual risk of that blown extremely out of proportion. But in any case, if the market actually feared that war, and this was seen as a de-escalation, we would probably have seen a positive reaction today. We didn't get that, right?
Exactly.
So ultimately, I don't think the market is super scared of the 10%. I think the market is scared of what might come if we get this tit for tat reaction, this chain reaction, where it goes back and forth, as we've seen between the US and China a couple of times back in 2025, right? Remember how they went from, we didn't get to 4 digits, did we, between the US and China on tariff, but it was close to at some point, right? Yeah. We got above 300 as far as I remember, and then we backed down again. But it was this back and forth, and they every time one part upped the game, the other part upped the game immediately after. I don't consider it likely that it will resemble that what we're going to see between the EU and the US. First of all, since the EU is not an institution that can take decisions that fast, it's simply difficult for the EU to respond to tariffs by just tweeting something out and say, okay, we'll match that. They cannot do that. They have to vote and they have to talk to each other and all that, right? And this is called the anti-coercion mechanism that they call it the EU bazooka when they're faced with a foreign threat on trade, for example. It is actually, as far as I understand, designed to be fairly slow because they don't want to incentivize this tit for tat, where you've raised the bar on a running basis between the two combating forces, right? So, and then I think you mentioned that initially, Mikkel, or to begin with. My personal base case is that Trump is not even capable of adding the 10% by 1st of February, at least not a broad 10%. He'll have to narrow it down to be able to use the national security argument. And therefore, to be honest, my best guess is that we'll probably get a rhetorical response from the EU saying that they have a package prepared in case that those tariffs go live the 1st of February. And then from there, they'll try to breathe easy and try to drag this out. I don't think we should expect an episode that kind of resembles what we saw between the US and China last year, because the EU is not that kind of institution.
No, Andreas, we discussed this a lot over the weekend and today as well, you and I. I just wanted to show you this, a list of 4 potential US or EU responses. So in the top is the lightest one, the classic tariff retaliation, we've called it. That's probably going to happen. Reciprocal tariffs, or what you might call it. That shouldn't be too much of a worry for investors, because that's subject to negotiation, etc. The next is it shouldn't say digital sales, a digital services sales tax. That would be a step further if the EU decides to hit Max 7, because the first step, the classical tariff retaliation, would usually be aimed at something like Harley Davidson motorcycles and bourbon and whatever, Levi's jeans, all those sort of symbolic things. But to hit the Max 7 with a heavy sales tax could be something. We could be looking at an export ban on microchips from ASML, and then obviously the big one could be something like a ban on owning U.S. assets within Europe in some way, shape, or form. We're very, very far from those points, but those are steps to look out for as you understand the EU response and how significant this is, in my opinion. So, do you think we'll stay at the top tier right now, or what's your assessment here? Yeah.
I think it would take a lot, let me emphasize a lot, for us to go below step one. Even a digital sales services tax is something that wasn't even close to being implemented during the first part of this trade war back in 2025. It was not on the table during the first Trump presidency either. So it's something that they'd like to avoid. You could argue that they already have a light digital services sales tax in place with all of the fines that they provide these Max 7s with in the Eurozone anyway. But joking aside, that is, I believe, the only out of the three others that could feasibly happen, which is probably also why we saw this repricing of nasdaq from the get-go of the futures trading, right? Because I mean, it's fair to price in the probability of a digital services sales tax in the Eurozone as a response to this. An export ban on ASML products, it's not a targeted measure against the US, so I think that would be very difficult. And then a ban on holding US assets. Well, you would need to make it a ban because, I hold a lot of US assets. You do hold some US assets as well yourself, Mikkel, right? So it's clearly not something you've managed to convince people of, doing just by watching the geopolitical play last year, right?
No,
it's something you'll have to force people to do because a lot of Europeans hold many U.S. assets. The Eurozone, I think, including UK, but the old EU, let me put it like that, holds roughly $8.23 trillion assets, which is more than twice the rest of the world altogether. So, I mean, this is obviously the nuclear bomb that you could use. But, hopefully we're not getting there. And I consider it incredibly unlikely. Let me put it like that. What I'd like to ask you about, Mikkel, is that, I've kind of had the impression, say, over the past day or two, that Trump is per usual trying to figure out where is the exact red line. One thing is that the Danes said it, but he's a cynical guy. So, he probably wants to test whether the Frenchmen, whether Keir Starmer will back down and so on and so forth. But we know that the Frenchmen and also the Brits, they have pretty vested interests in, defending territorial interests next to the US, if you know what I mean, with several islands included in both of those countries, right? So how do you see this, from a political perspective outside of Denmark? One thing is the Danish stance, but what about the French, the British stance, the German stance in this?
Right now we have a almost completely united European front on this issue. At least all the major European military economies are united on this. There may be some wrinkles on Italy and Meloni's support to this, but that's relatively minor for now. And even so, if they activate the anti-coercion mechanics, it's not a you don't have to have all the votes. That doesn't have to be unanimous, so that can be worked around. The big question here is what screws could Trump turn, because tariffs is not going to be enough to break up this united front he's facing in Europe. It would probably have to include either LNG, natural gas, which a lot of the European countries, the further you go to the south and the east, they're usually more reliant on that. And we're trying to wean ourselves off Russian gas. So if we can't have US gas, if they shut off, what on earth are we going to do? And the Europe is very, very, that's essentially our biggest Achilles heel, is that we don't produce any energy ourselves. So that is one step that the US could take to really put the pressure on Europe. it's also very, very hard to move back from. It would break a lot of trust with the European Union. But it is a step that could be taken. Other than that, we are seeing a very, very strong united European front. We are seeing European military advisors going to Greenland last week. There was a lot of fake news about these guys fleeing Greenland once Trump issued the threat of tariffs. Let me just say that's completely fake news. These were not soldiers meant to jumping in a ditch and shooting. These were guys with laptops going up there for a meeting and going back. So that was always the plan. The plan is not to put 100,000 soldiers in Greenland, because Greenland is so massive. What on earth would they be defending? The idea is to start having some talks within Europe and within NATO on what can be done to defend Greenland better in the future. What could such a package look like? We've covered that a bit. There are some investment ideas into that, because at the end of the day, I think the most realistic outcome of this is increased investments into the defense of Greenland. We've talked about ships. We've talked about drones. One thing that was mentioned to me earlier today was the Golden Dome radar network that Canada is investing heavily in and has been using it as a way of easing Trump's rage against Canada. That could be a way, and some massive investments in that over Greenland would make a lot of sense. So, I mean, there are some ways to this, but the fundamental issue is still that Europe and Denmark considers Greenland as something that can't be sold, because the Greenlandic people decides this issue. And they don't want to join the US, so Denmark and Europe doesn't think that Greenland can be sold. And on the other hand, the US is looking for a price to something that can't be sold. And that is, at some point, these parties are going to have to talk the same language if this is to be resolved.
But Mikkel, I don't know how to phrase, but maybe it can actually be bought, if you know what I mean. Because, if I were to, one thing that I continuously see the US side of this misunderstanding is that they have to talk to Denmark.
Yeah, exactly.
And they can, in principle, they could go directly to the Greenlandic people and say, what's the price here?
And they should. And I mean, the Greenlandic people are not going to be faced by, are not going to be worried about tariffs on the EU and all these measures against the EU. That doesn't matter. They want independence, and they don't see a path to independence through the US. So they would have to be convinced otherwise. Right now, they're very, very explicitly wants to stay as a part of the Kingdom of Denmark. That's not because they love it in our kingdom, to be honest, Andreas, but they prefer that to the US. And that's sort of, Trump hasn't sold the idea on joining US to the Greenlandic people, simply. Yep. And that's the key point, because if he had managed to do that, if the Greenlandic people wanted to join the US, a deal could absolutely be made.
But the simple bottom line, and maybe that should be my final words on this Greenland question for now, is that it is incredibly gullible to think that these 50,000 people can decide for themselves on the biggest island on Earth. It's not going to happen.
True. They don't have a free range of options, but they do have some level of self-determination. Obviously, they can't choose to be a Chinese puppet, but anyway, that's where the current misunderstanding is, and that's why we don't see real negotiations, because the two sides are talking completely different languages right now.
Yes.
So, okay, Andreas, maybe that's enough about Greenland. It's a very contentious topic. I know it's difficult for us to sit here as Danes, but we're trying to be as objective as possible and laying out the way we see it as analytical as possible. Let's talk a little bit macro, Andreas. We published, in my view, a very good article on Friday, looking into the CapEx picture of 2026, and we covered this in our comprehensive outlook for 2026 as well. But it seems like we are getting some fuel to that fire with the depreciation rules, etc., going on. What is it that you're seeing that makes you so upbeat on this CapEx season, as it's been called?
So outside of getting this punch to my face, so to speak, not literally speaking, but you know what I mean, over the weekend with this Greenland stuff, I was so upbeat on Friday because everything started to line up, and the stars were aligning for this super CapEx cycle this year. We've had strong regional PMI data on CapEx, which is fits hand in glove with my thesis that Basically, as of today, you're incentivized to do a lot of CapEx this year due to this change in tax rules. And it's, by the way, only this year. So it's again designed to make the economy fire on all cylinders ahead of the midterms, right? And then on top of it, we're also seeing this rotation beneath the hood that kind of supports the notion that there's actually a cyclical uptick on the way. We've seen, I think, 10 sessions in a row with small caps outperforming large caps. It's typically not something we see unless the economic cycle is doing very well. And the good news, the piece of good news here is that most cycle-sensitive assets, take the Russell 2000, take Bitcoin, they're priced for what I would call mediocrity. If you look at it year over year, in the dark blue here, we're basically priced-ish around an ISM manufacturing cycle that doesn't really move a lot, which has been the case 3 years running. So let me just highlight that. So if we get, say, a 10 index point increase in the PMI cycle this year, getting us to, say, 56, 57, 58, that range, we have loads of returns ahead of us still this year. And the regional surveys last week kind of confirmed that picture. So unless we get another, tariffs-based roadblock, I'm fairly confident that the cycle will do well the next 3-4 months. I actually feel very comfortable that the cycle will do well. The caveat, and I have to remind you of it again because it has happened twice last year, is that if we get a complete standstill in trade patterns, we got that in October with the second standoff with Xi. We obviously got that after the Liberation Day in April as well. It takes the economies, at least a few months to recover from such an exogenous shock, and that exogenous shock cannot be ruled out. I considered it ruled out on Friday, but I don't consider it ruled out here on Monday. Let's see. My base case is that this will not turn into a violent tit-for-tat trade war. And in such case, and repeat is my base case, February to April will be one of the strongest spikes that we've seen in the PMI in over the past decade, in my opinion.
Extremely interesting, Andreas, and very, very upbeat message here. Very interesting to follow this. I just wanted to tease a little bit about, Andreas, about another topic that we've been covering. You can read much more about it on Real Vision, the approach here. We talked a lot about this graph, this chart last week, Andreas. The AI software versus hardware and electricity baskets. So we've talked a lot about AI hardware, about data centers, about them needing electricity. But maybe, just maybe, there's a case to AI software being the next move. Can you just explain to us a little bit about the thinking behind this and your thesis here?
Well, at least since we got the announcement of Claude Code, it kind of seems like all software companies kind of trade in, at least if you extrapolate it in a straight line towards zero, right? Yeah. And I mean, I kind of get why, but I'd like to see Claude Code solve the SAPs of the world before I really truly conclude that. But for sure, I mean, even our small little shop, Mikkel, we have, I don't know, a couple of handfuls of software subscriptions. I myself think that most of those software subscriptions will be worth zero in a year from now. So there's some merit to why at least less complicated software will prove worthless, more or less, due to the extremely solid development of LLMs, right, and Claude Code and so on and so forth. Having said that, I guess we'll need to figure out when the S-curve deaccelerates again. And I think it's very, very hard to buy software as long as an LLM doubles its capability versus an actual software engineer every 5 months, which is currently the case. Every 5 months, we see a doubling.
We have the chart here, yeah, exactly. And I mean, measured in the amount of time that specific tasks would take a human, it looks like the beginning of an exponential, or this is so far an exponential development.
It is.
The question is, at what point does that begin to normalize or to break off into an S shape, as you predict? That's
yeah. Ultimately, if it keeps doubling, it doesn't take more than a handful of years for us to get to something that would take an engineer many years, right? So, and in such case, I mean, the engineering job is obviously done. I mean, it's done and dusted. You can't, I mean, more or less, right? So whether this turns into an S shape this year, next, 2028, I'm not the right guy to answer that. But as long as we're in this part of the journey, I would stay at least mostly off software as a basket, and rather, consider which physical constraints this development will face, right? And that's basically the electricity and hardware stuff. We have much more exposure to electricity and hardware than to software. We have a little software, and it's served us very well so far. I think we're up. Now that the U.S. equity market is closed today, I can actually safely say that we made money today with the few positions we have outside of the U.S. So haven't had a red day so far this year, which is more or less a miracle. So let's see.
Yeah. Up just around 16% year to date. We're really good, Andreas, obviously, with a lot of these bets. Also, some of them making money on the Greenland case, some of the drone bets and other stuff.
Yeah,
perhaps,
but it wasn't designed on the back of a Greenland analysis, to be honest. But
absolutely not.
I personally tend to think that there are a couple of companies involved in mining in the very south of Greenland, and those bets are kind of obvious: critical metal corps and so on and so forth. But other than that, it's actually very hard to find any way to sort of directly hedge against what's going on in Greenland. What I can say, and I'll probably not get a lot of friends by saying that, but I think it is evident that if we talk about a geopolitical shit show, you'd rather want gold than Bitcoin in your portfolio. If we talk about a shit show around the US dollar and the Fed, you probably rather want Bitcoin than gold. So it depends on what you're hedging here. If you're hedging a complete melt up, or meltdown rather, of NATO, buy gold instead of Bitcoin.
Very interesting distinction there, Andreas. Let's keep that as the final point of this week's Macro Mondays. As mentioned, Andreas, we'll be going to Miami for the crypto gathering, the Real Vision crypto gathering. Still time to catch your tickets if you're in the area in Miami Beach. We will most likely be doing next week's Macro Mondays from Miami. Hopefully, a bit better weather than we're having here in Copenhagen, and a bit more sunny outlook also in markets. Perhaps, Andreas, we'll see about that. Thanks to everyone for joining in. We didn't have time for too many listener questions today. We'll be catching up on that during the coming weeks and on the platform. Once again, if you are a Real Vision subscriber, do reach out to us on the platform. We are very active there. We are posting on the feed in there. We are answering direct messages. So do reach out to us in there, and we'll get your questions as well. So thanks to you for joining, Andreas. Thanks to everyone for listening. We'll be back next week.